Do you think it's too late to start investing at 40? There's a common misconception floating around that investing is a young person's game, that the ship has sailed if you didn't jump aboard in your 20s or 30s. But let's challenge that notion today. Let's shake off those constraints and introduce a new perspective. Investing isn't about age, it's about the right mindset and the right approach. But what if I told you, it's never too late to begin your investment journey? Age is just a number when it comes to investing. That's right, folks, there's a common misconception that if you haven't started investing by your early 20s, then you've missed the boat. But that's simply not true. Now let's debunk some myths about age and investing. Myth number 1, it's too late to start investing at 40. This is a myth because there's no such thing as too late in the investment world. In fact, starting at 40 can come with its own set of advantages. You're likely in a more stable financial position than you were in your 20s, making it easier to allocate funds for investing. Plus, you've got years of life experience under your belt, helping you better understand the market and make informed decisions. Myth number 2, older investors can't handle the risk. This is another myth that needs debunking. While it's true that risk tolerance may decrease as you age, it doesn't mean you can't handle it. By diversifying your portfolio and choosing a mix of low-risk and high-risk investments, you can manage and balance risk effectively. Myth number 3, you need a large amount of money to start investing. This is a common myth that deters many from starting their investment journey. The truth is, you can start investing with as little as you have. The key is consistency. Regularly investing small amounts can accumulate into a significant sum over time. Myth number 4, investing is too complicated for beginners. This myth can be debunked by the sheer number of resources available today. From books to online courses, there's a wealth of information out there to help you understand investing. With a little time and effort, you can gain the knowledge you need to make wise investment decisions. So, as you can see, starting your investment journey at 40 is not only possible but can also be highly beneficial. The age factor should never be a barrier to your financial growth. It's all about perspective, determination, and taking that first step towards securing your financial future. Before you jump into the world of investing, it's important to understand the basics. Let's start with the concept of diversification. Picture this, you're at a buffet, and there's a spread of all your favorite dishes. You wouldn't just pile your plate with one dish, would you? Similarly, when you invest, you wouldn't want to put all your money into one company or one type of investment. This is what we call diversification. It's about spreading your investments across a variety of assets to reduce risk. Now, speaking of risk, that's our next fundamental principle of investing. Risk and return are two sides of the same coin in the investment world. Higher risk investments often promise higher returns, but they also come with the potential for higher losses. On the other hand, lower risk investments usually offer lower returns, but are also less likely to incur significant losses. It's all about finding the balance that works best for you. Another important concept to grasp is the idea of buy low, sell high. It may sound simple, but it's often easier said than done. The key is to remain patient and disciplined, avoiding impulsive decisions based on market fluctuations. Lastly, let's talk about the power of compound interest. Albert Einstein once called it the eighth wonder of the world. Why? Because it's the process where your interest earns interest, and then that interest earns more interest, and so on. It's the snowball effect that can help your investments grow exponentially over time. To sum up, diversification helps to spread your risk. Understanding risk and return helps you choose the right investments. Patience helps you buy low and sell high. And compound interest helps your money grow faster. With these basic principles in mind, you're ready to take the first step in your investment journey. An investment strategy is a roadmap to your financial goals. In this grand journey of wealth creation, having a clear strategy is as crucial as having a compass in an uncharted territory. It's like your personal financial GPS, guiding you towards your destination. Financial independence. Let's dive deeper into how to create your own investment strategy. The first step is to identify your financial goals. Are you investing for a comfortable retirement, a dream vacation, your child's education, or to simply grow your wealth? Identifying and articulating these goals helps shape your investment strategy, giving it a clear direction and purpose. Next, you need to assess your risk tolerance. This is a crucial step as every investment comes with a certain level of risk. Your risk tolerance is determined by your financial situation, your investment horizon, and your personal comfort with potential losses. Are you a risk taker? Ready to ride the roller coaster of stock market fluctuations? Or are you a conservative investor, preferring to take the slow and steady path towards wealth creation? Understanding your risk tolerance helps you choose the right investment vehicles and manage potential losses effectively. Now let's talk about choosing your investment vehicles. This is where your goals and risk tolerance come together to shape your investment portfolio. If you're aiming for higher returns and can stomach some risk, you might consider stocks, mutual funds, or real estate. If safety is your priority, bonds or money market accounts might be more your speed. The key is to diversify your portfolio, balancing risk and reward. Finally, remember to review and adjust your strategy regularly. The financial market is a dynamic entity, and your personal circumstances may change over time. Regular reviews ensure your strategy continues to serve your goals effectively. Remember, a well-planned investment strategy is your key to financial success. It's your compass, your GPS, your roadmap to wealth. And with this roadmap in hand, you're well on your way to navigating the financial landscape and reaching your desired destination: financial independence. If you liked the video so far, make sure to like and subscribe so you don't miss our future videos. Now that you're equipped with the basics and have a strategy in place, it's time to start investing. Step 1 is opening an investment account. This might feel like a big step, but it's simpler than you might think. Most banking institutions offer investment services, so check with your bank first. If they don't provide the options you're looking for, there are plenty of online brokers and robo-advisors that can help you get started. Once you've opened your investment account, you'll need to fund it. This could be as simple as transferring money from your savings or checking account. Keep in mind that investing involves risk, so only invest money that you can afford to lose. Now let's move on to step 2, choosing your first investment. Remember the investment strategy we discussed earlier? Here's where it comes into play. Whether you've chosen to invest in stocks, bonds, mutual funds, or real estate, make sure your first investment aligns with your strategy. Consider factors like risk tolerance, investment time frame, and financial goals. For example, if you're risk-averse and looking for a steady income, you might want to consider bonds or dividend-paying stocks. On the other hand, if you're willing to take on more risk for potentially higher returns, growth stocks or real estate investments might be right for you. Finally, step 3. Regularly monitor your investments. This doesn't mean you need to check your account every day, but you should keep an eye on how your investments are performing and make adjustments as needed. Remember, investing is a journey, not a destination. It's okay if you make mistakes along the way. What's important is that you learn from these mistakes and continue to grow as an investor. And just like that, you've taken the first step towards becoming an investor. So you see, it's never too late to start investing. We've traversed a path today that has hopefully shed some light on the misconceptions about age and investing. It's not a young man's game, nor is it exclusive to financial whizzes. Rather, it's a game of strategy, understanding, and taking that first step, no matter your age. We've explored the foundations of investing, from understanding the basics to creating an effective strategy. We've debunked the myths that may have been holding you back and highlighted the importance of financial literacy. Remember, knowledge is power, and with this power, you can make informed decisions about your investments. We've also taken a deep dive into how to get started, emphasizing the importance of setting realistic goals, diversifying your portfolio, and staying patient. Investing is not a sprint, it's a marathon, and it's never too late to join the race. So, let's recap. Age is not a barrier, knowledge is your power, strategy is your roadmap, diversification is your safety net, and patience is your virtue. Each of these elements contributes to a successful investment journey. The road to financial security may seem daunting, but remember, the journey of 1,000 miles begins with a single step, so why wait? Start your investment journey today and pave the way to a financially secure future. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, We do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions. Thank you so much for watching. I hope you liked the video. I'll see you in the next one.